Good morning, everybody. This is our first installment for Deal of the Week. We're going to be digging into the mindset of somebody who wants to build a portfolio of real estate. And our first installment is going to be actually in Charlotte, North Carolina, piggybacking off some research that I've been doing, helping my client out recently. And so, again, we're going to look at this from two different mindsets. One, if you're going to be doing the stair step method, which is buying a primary residence, living in it for a period of time, saving up, buy the next one, and turn that original property into a rental. The second part of it will be just, hey, outright as an investor, putting 20, 25% down, buying something and renting it out using various lending strategies. So the very first one we're going to do here is going to be in Charlotte. And this is going to be someone looking to purchase their first property, digging into potentially some loan programs and down payment assistance. It's going to be a 3-bed, 2-bath townhouse. So what is someone going to look like in terms of the data, the numbers to buy, and then ultimately rent out long term? How do the numbers look? And does the deal work or not? Does it make sense, or should they keep looking? So further ado here, let's see what we got. We are going to dig into our first property here. So this is going to be, again, we are in Charlotte, North Carolina. I'm going to share my screen here. We are in Charlotte, North Carolina. I've got this search on Redfin, 300K and below, 3-bed, 2-bath. And we're going to zoom in here to the area east of Charlotte in the suburbs. And I'm going to maximize this part that we're sharing here. If I can figure out how to do that. Boom. And again, for those of you who don't know me, my name is Joel Farrell. I've been in the mortgage industry since 2006, built a portfolio of real estate using the stair step method along the way. I bought my first property in 2009. And being on the lending side of things, seeing things from the real estate investor lens, seeing things from the financing lens. Finance is the language of the rich. If you can harness the power of finance, you're going to be able to build wealth in some regard. So again, the stair step method, that's what I call this, scaling into real estate using primary residence financing, conventional loans, FHA loans, these things to be able to buy a property, live in it for a couple of years, save up, and then turn the old one into a rental. So throughout this process, we're going to dig into the numbers and then go through and talk through some of the logic behind it as well, what may make sense and what may not make sense. So you can see the map here. We are in Charlotte. Some of these properties, 250, 229, 240. The property that we picked out is 5237 Ficus Tree Lane. It's a 3-bed, 2-bath townhouse for $240,000. So property looks nice. Here's some of the pictures. It is a townhouse, so there are going to be association fees that will build into the analysis. Taxes are relatively cheap as well, which is going to help the numbers. So this one, little patio. You've got, I think this might be virtually staged. It looks like this bedroom here, virtually staged, but it looks pretty clean. Nice hardwood floors. It's got some decent bathrooms. Bathtub, shower, cool, ceiling fans upstairs. So it's multi-level. House looks pretty clean, simple, straightforward. So I'm going to get out of the photos here. We're going to dig into some of the data. So if you scroll down here, I'm going to just point out where I found some of the pertinent data. So HOA fees, you can see here, $205 a month. We'll build this into the analysis. Property taxes, $156, homeowners insurance, $94. So you're talking about $250 a month. And then one thing to be aware too from a financing standpoint is that this is a townhouse. If this were a condo, the financing adds an extra wrinkle into the approval process. You may be qualified as a buyer, but on a condo, we have to get the condo association approved through Fannie and Freddie Mac guidelines, which again, not all condos are going to be approvable depending on delinquencies, depending on if one entity may own too many percentage of the units, if HOA fees are delinquent for a certain percentage. There's various things that can make a condo association not approvable. So here is the basics of this property. And again, looking at this from a primary residence standpoint, what we're going to be looking to do is map out some different strategies in the lending to get a ballpark on a payment. And then also look at that from a lens of a few years down the road. What does it look like in terms of renting it out? And so first thing, I'm going to look at the analysis for rent. Okay, so for rent, estimated rent's $19.65 a month. We'll fast forwarding here a little bit with some additional analysis. $19.65 a month. Okay, so that means that we're going to be trying to get the payments below $19.65, ideally. So again, is this still going to work or not work? I don't know yet, but we're going to dig into the analysis. So we're going to assume somebody's got a 720 credit score, so pretty solid credit score. Buying it as a primary residence, we have a couple different options. So getting into the nitty gritty here of the details. So FHA, 3.5% down right here. Conventional loan, first time home buyer, 3% down, 3% down here. So you can see that. And then this third option over here is a 3% down conventional with a grant. This actual property is in a grant zone that we, at my company, New American Funding, have some grant money for first-time home buyers that would provide a $6,000 grant towards closing costs. So that's for a conventional. And again, there's a lot of down payment programs out there. This is just one example to give you an idea. So this would actually make the rates a little higher than the other conventional loan, but then it would bring the out-of-pocket down by $6,000. So that's a different part of the analysis. But right now, we're just focusing on the payment and the projected rents to see how this stacks up down the road to potentially rent it out. So FHA, you're talking about 3.5% down. You see that here. The rate I'm using is 5.875. Please note, it's just an example. Don't put any type of credence to this in terms of rates and dates and APRs and fees. It's just a rate. These are all just examples. Not quoting rates, just giving you the comparisons as you look at these side by side. So if you want a rate quote, let us know. So these numbers, don't take anything in terms of market rates. This is just for comparison purposes. So here we go. You can see the breakdown of what's going into the payment. I'm going to just go line by line. We got the principal and interest, $1,393 and change. Monthly PMI, 108. Taxes, 125 a month. I pulled taxes online. 24 taxes are 125 a month. Homeowners insurance, $100, and then townhouse HOA dues, $205. Now your mortgage payment's not going to include HOA fees, but for this comparison, I'm going to add it all up, and we get to $1,931. Okay, so FHA, 3.5% down. The payment's $1,931. So what do we have for the rent analysis? It said $1,965 a month. Okay. So I mean, in theory, you fast forward the clock a couple of years, you might cover your payment. That's not going to blow you away. Okay. And then if you come back to these other scenarios for conventional, you've got the rate at a little bit higher level, 6.375. Your payment's going to be 2018. The PMI is going to be a little bit higher on conventional. So you got a $2,018 payment here. So at $1,965 in rent down the road versus 2018 payment, that actually may not make sense. And same thing with this grant scenario. The rate's going to be a little bit higher with the program. The payment's going to be a little bit higher by about, what is that, $40, $2,056 a month payment. So, again, that rent and grant scenario may not make sense. Now, if you put more money down on this, 5% down, 10% down, then the deal probably would make more sense. Again, but that's for a different day. So now I'm going to skip to DSCR and then come back, because to make this deal look more attractive, maybe in this environment, the property's been on the market for a bit. Maybe you go in at an aggressive offering and you offer, say, $220K. And that's a scenario that I've previously put together. So we'll see $220K, how it stacks up here in a few minutes here. So, one of the things we talk about is, okay, you buy a property, live in it for a period of time, turn it into rental. Home price appreciation will come into play. Your value of the house is going to go up 3 to 4% per year. Again, it's an assumption over history. Short-term periods of time, things are different. We look at the 08-09 crash. But just for example purposes, you're going to see the value of the property go up over time, 5 years, 10 years, 20 years. You can see some of these numbers here. This is a breakdown of the payments. And then equity build up over time. You can see in 10 years, in the 127 to 135 range of equity build up over time. So that's one of the examples of leverage with real estate. You put 3% down, and over 10 years, you build up $135,000 of equity by putting down, because 3% on 240, just pulling out the calculator again. Oh, wrong calculator. It's not working. Not working. 240 at 3% is 7,200. So looking at this, just bottom line, you're talking about putting down $7,200 potentially, and then when you turn into a rental, a renter's paying, you're making your payments, assuming you break even on cash flow and expenses, you're building up equity over time with your renter paying down the mortgage, and then the value's going up over time. You're getting the appreciation on the entire home, 3% on the entire value, while only putting down a small portion of cash to have full ownership of the asset. So, one of these properties, right, is great. $135,000 of equity built up over 10 years. Again, 10 years is a long time. But what I see some people do in the game, and I've got plenty of examples of this, DeMarco Anderson on the Strive for 25 podcast, I forget what episode, he's in the IT world, and he basically bought 4 properties in 4 years in North Carolina and Houston, working multiple full-time jobs, and bought properties as a primary, turn the old one into a rental, rinse and repeat. And, you put on the gas pedal and plant these seeds, and over time, and you're able to pull back off the gas pedal. So some people are doing this every couple of years. DeMarco's example was a little maybe extreme. He bought 4 properties in 4 years, but a lot of the examples that we give on this channel is buying one every couple of years. So let's just say 4 and 8 years. So when you start to stack these, that's where it starts to get interesting in terms of the ability to build massive amounts of wealth and building a multi-million-dollar portfolio. So back to the DSCR analysis, okay? So if somebody were to buy this as an outright rental, a DSCR loan, for those that are not aware, it stands for debt service coverage ratio. The difference between this loan and a traditional loan, a traditional conventional FHA, VA loan, you're looking at someone's total income profile, that W-2s, pay stubs, tax returns, all that stuff. Whereas for DSCR loans, we're just looking at the property's rents, the credit profile, and assets. So we're looking at more of the property for qualifying as opposed to the person's personal income. So we're not even going to request and need to look at tax returns. So it is a hack for real estate investors to rinse and repeat. We're just looking at the property. Now, the biggest limiting factor is having the cash available. So that's just the one thing to be aware of. You got to have the cash available to put 20 to 25% down, et cetera, et cetera. And so the key thing is that we're going to look at the gross rents and then compare that to the mortgage payment. And that ratio of rents to the mortgage becomes your DSCR ratio. So in this scenario, 20% down, which is $48,000. I'm just using, again, a just general rate of 7.5%. So you got your principal and interest payment. There's no PMI, taxes, insurance, HOA. So your all-in payment's going to be $1,772 compared to the other scenarios where the payments are going to be, around $2,000, give or take. So again, this example, you're putting down 20%. So more money down means a lower loan amount. So, okay, let's say you get $1,965 in rent and your payment $1,772. Okay, you're covering your mortgage payment, or you're not, because there's going to be expenses and upkeep and trash, water, sewer, maintenance, various things that are going to go into the equation. So you got vacancy percentage here that's built into this analysis, 5%. This is going to take into account some operating expenses, $2,400. So your net operating income before debt service is $20,000. Annual debt service right above here, you see the payment including taxes, insurance, HOA. So in this equation, your net operating income versus your debt service, you're going to be in a negative cash flow perspective. So in this example, the deal doesn't pencil. And then coming over here, this right column, you've got a 25% down scenario. So $60K is going to be your down payment. So a lower loan amount. And in this case, I used a little bit of a lower rate as just an example, 7%. Again, it's not a rate quote. It's not an APR. It's just literally just for example purposes to get the concept of how things can change. Going from 20% down to 25% down is going to have an impact on rates and how these are priced out. So just be aware of that. It's just an example. So payment's going to be lower. You're putting more money down, so your loan amount's going to be lower. So more money down. And all in all, your payment's going to be about $150 lower, $140 lower. So $1,627. So your deal's going to pencil out a little bit better. Your annual cash flow, instead of being a negative number, now you're at a positive cash flow number. So cash on cash returns, okay, cool. These percentages, they're just estimates. So does this deal pencil out in its current form? It doesn't blow me away at all. Right now, if you just have money to spend and you want to get into a deal, cool. You want to plant that seed, and maybe a property you can increase rents if it's under rented, or maybe you get a really good deal. There's different ways to be able to improve the value of a deal. But in this case, no, this is just kind of generic numbers. Now, let's say that you get the right seller and they accept an offer below list price, because again, this one's listed at $240. So this scenario shows analysis for a primary buyer and the DSCR buyer with a price of $220. Now, is it possible that they come down this far? Who knows? But for example purposes, this payment, instead of being just, I think it was $1,931, this payment is now $1,793. So about $150 lower or so. This payment, $1,897, as opposed to being over $2,000. Yeah, $2,056. So that $20,000 difference is going to have obviously a decent impact on payment here. So if you were able to get this at $220, now the deal may pencil out as a primary residence buyer to have that become a better situation to rent it out, down the road. And then the DSCR buyer coming in at $220. Again, this is going to bring the numbers down a little bit. So $1,660. And that DSCR payment was $1,772. So a little over $100 lower. So that's going to help your deal pencil out a little bit better. And here's the analysis. Annual cash flow. Now that becomes a positive number here, your cash flow becomes a positive number. So again, you've got your 4 pegs of value in real estate. You've got your appreciation, you've got your cash flow, you've got your mortgage pay down by your renter, and then you've got your depreciation and tax advantages. So this is just some basics on digging into a deal. So we've been going for maybe 15 minutes or so. If you have any questions on analyzing a deal, please do comment somewhere on the channel. again, this is a live stream, so I'm going here and I'm not actually looking at comments right now on the stream. I'll do that right now. But yeah, wherever you are, if you have any comments or questions, and wherever you're watching, just jump into a post or a reel and just ask a question anywhere you may have if you want to dig into a deal. And I'm going to stop sharing my screen here. But again, the biggest thing that I'm having conversations with real estate investors on right now is really it's rates, talking about interest rates. And rates have been flat for the last couple of years. Bond yields have been around 4%, give or take. And there's talk of rate cuts coming up in September. So what's going to happen? Nobody really knows. But I think if rates do go down significantly over a period of time, you're going to see a lot of people that are on the sidelines jump back into the game. There's a lot of pent-up demand that I believe is out there. So what are investors doing? Seasoned investors right now, they're putting offers on lots of properties. I have people putting offers on multifamilies, 4 families, 6 families, 10 plexes, properties that need renovations, fix and flips. And you put enough offers out there, it's a numbers game. You put enough offers out there, you might find the right seller that's motivated to take your terms. And again, nobody knows what's going to happen with rates. But if you can get a deal to pencil today, if rates do go down the road, then that could potentially make it advantageous to refinance and restructure and lower payments and then rinse and repeat. So if you have any questions, again, let us know. Let us know. We're going to be doing this. The goal is to do it every week in a different city and then come back around and continue to do it. And we're going to be bringing on some specialists in a couple of different platforms and areas. We're going to be in Pittsburgh, Pennsylvania, tapping into some specialists over there. We're going to be in Miami, tapping into a couple of multifamily specialists. We're going to be in St. Louis. We're going to be in the DC market. We're going to be in Florida. We're going to be in Nashville. Those are 6 markets that I know that we're going to be digging into surely in the coming weeks. So thank you all for, we got some comments here. Flavio, Macias. What's up, Flavio? Thanks for stopping by. Mark, aloha from Hawaii. Hamu. Thank you guys for stopping by. But yeah, we're going to be doing this every week here. So this is just kind of like your test run. It took me way too long to put the analysis together. Man, I was trying to do this at 4 o'clock, which is an hour and 30 minutes ago. And then I got stuck on a couple of things because the numbers weren't working properly on the analysis. But that's okay. So we'll keep doing this every week. And if you guys have any questions or any areas you want to dig into, let us know. But this will be kind of going from your primary residence buyer example to that investor looking at properties as well. We'll dig into multifamily. We'll also dig into your typical fix and flip as well. So it's going to be a fun ride here as we get through the end of the year. I'm excited because we're kind of in the eye of the storm right now because I mentioned rates. I think rates are going to be coming down soon. The bond market's already pricing this out. It looks like it's going to continue to price the rate cuts in as the bond yields have come down from where maybe a week and a half ago at 4.2, 4.3. Now we're at, where are we at right now on the bond yield? 10-year treasury. Okay, we're right under 4.3, whereas a week ago we were at 4.4. So we'll see what the markets do. But I think you're going to see a lot of activity coming up in the next few weeks as we get into September and see what the Fed does with the next meeting. So lots of talk, lots of speculation. And maybe for the next video, I'll talk about the Fed meeting in July. And then what do you know? We revised the job numbers the next day. And now the job market, the economy looks bleaker after the Fed meets. And there was a lawsuit that was trying to open up the Fed meeting to the public, but there was a closed door meeting. And so they blocked that. So it'll be interesting to see what happens as things unravel and unfold. But thank you guys for staying tuned. The next one will be more interactive. We'll bring on another guest and dig into a different market. But this one today is number 1 in Charlotte. We'll be gearing up for the next one in Miami next Tuesday. All right, y'all. Take care.